Good morning. I'd like to introduce Karen Syrylo, who is going to give a presentation on the legislative update from this past session of the Maryland Assembly.
Good morning. Yeah, this is our annual review at the MACPA State Tax Committee of the Maryland tax legislation that was just passed in last month's close of the legislature session. Actually, today I want to cover three topics. One is mostly the tax legislation that was passed in the 2013 session. A very quick list of a few of the bills that were proposed in the tax areas but that did not pass. It gives you a flavor of the kind of things that people are thinking about and may come back in future sessions. And then a brief summary of the status of two very important tax court cases that we're watching in Maryland. I know a lot of us have been following the Wynn case and also the Gore case. I'm going to tell you where those stand right now. Well, in the 2013 General Assembly session, it was fairly typical in terms of the total issues that the General Assembly looked at. They actually reviewed proposals in 2,610 bills, 766 of which passed. And those are of all sorts of topics, not just taxes, but everything else you read about in the paper and a lot of things that you don't hear about. We're only today going to be covering a couple dozen of those bills because we're only talking about the tax bills. But even in the tax bills, some of the things that I'm going to be mentioning for you are things that you may not be interested in, but I mention them very quickly anyway, just to show you the breadth of the topics that our legislators do deal with, even in our field of the taxes. Now, today's presentation and my notes are meant to be a very, very brief summary. I'm going to be going through things pretty quickly, some detail about the more important things that I think many CPAs deal with, but still it's meant to be a very, very brief summary. So for those of you out there in video land, if you hear anything that you want to know more about, please don't hesitate to post a question to the listserv, and I or somebody on the State Tax Committee will get back to you with more of the details. So here we go about 2013 tax legislation. Certainly the most talked about tax issue that hit the papers for months and months was the transportation funding bill. House Bill 1515 was the proposal from the governor's office, the administration. And what we ended up with was several pieces in the transportation funding. One is a phase-in over 3 years of a 3% sales tax on the price of gasoline starting July 1st of 2013. Now this is in addition to the current per gallon excise tax on gasoline. So we're going to have both the per gallon tax and the cents per dollar sales tax on gasoline soon. Another important piece that you probably heard about was that there is a proposal or provision that part of the additional sales tax revenue that would come from when Congress, when Congress passes the Marketplace Equity Act, the Internet Sales Tax Act, part of that sales tax is supposed to be dedicated to the Transportation Trust Fund, which, in Maryland we have several different pieces of our budget. The Transportation Trust Fund is a separate, basically, bank account from our general fund, and the extra sales tax revenue that's supposed to come from the internet and remote seller taxation is going to be dedicated to the Transportation Trust Fund as long as Congress passes that bill by December 1st of 2015. Now, you may have read that recently that bill did pass the U.S. Senate. It's now up for consideration in the House. There is both support as well as opposition to the bill in the House. We can talk about the details of that off camera. But if the bill does not pass the House and therefore has not passed the Congress, the sales tax on Maryland's gasoline rises an additional 2%, 1% over each of the succeeding years in 2016 and 17. So what happens in Washington and Congress is going to directly impact Maryland's taxation. Another provision is to protect some funding. The gasoline excise tax, that per gallon tax, is going to be indexed on an annual basis based on the consumer price increase, but the consumers were successful in at least having the bill have a cap on that increase. It can be no more than 8% per year. Also, the Maryland Transit Administration fares, bus fares, and the like are going to be adjusted every few years, but also based on the CPI. And a work group has been established to study local and regional transportation funding and have the Maryland Department of Transportation evaluate various alternatives. There are a lot of different things that happen across the country, different ways that states and localities fund their transportation needs, and so a study group is going to be looking at those. Now, for us CPAs, a team of people from the Comptroller's Office, the Department of Transportation, those folks are currently working on details of how these tax changes are going to be administered, new forms, et cetera. So any of you who have gas station service company clients, gasoline wholesaler clients, you'll be getting information. They will be getting information shortly as the Comptroller's Office and the department are providing the forms and the details soon. And last but not least about transportation funding, important to all of Maryland citizens, is in 2014, Maryland voters will have the opportunity to vote on a referendum question. A big part that you've probably read about in the newspaper about our transportation funding in Maryland has been the matter that for several years and several administrations, borrowing has been done from the Transportation Trust Fund revenue, which up till now has mostly come from things like the gas tax and transportation fares like the bus fares and things. But several of the governors and legislatures have seen fit to borrow money from the Transportation Trust Fund in order to fund general budget funding needs. And the folks who are advocates for the transportation funding, you know, we have bridges that need redoing, we have potholes that need fixing, we have new roads that need to be built, have been concerned about that. And so an effort was made in the legislation that did not pass to actually get a very tight, what's called a lockbox provision. The lockbox provision will be a referendum question in 2014, so voters will have the opportunity to vote on a change to the Maryland Constitution that would say that in order for the government to borrow funds from the Transportation Trust Fund and use them in general funding needs, it would require a 3/5 vote of each, the House and the Senate, before that borrowing could be done. So you'll see that on your ballot in 2014. So that was the big issue of the Transportation Trust Fund that is meant to generate hundreds of millions of dollars per year for Maryland-specific transportation needs. Moving on now to some other things, some of which did get some publicity and some of which I'll go through very quickly. They didn't get publicity. One other very important matter that a lot of us had been dealing with for quite some time now was the questions about tax issues that impacted Maryland's same-sex married couples. There were a lot of questions, the fact that the federal code currently does not attribute married filing joint status to same-sex couples, even in those states that have same-sex marriage under their law. And Maryland has coupled up till now with the federal code. But in the 2013 session, we had a couple of bills that have changed that. House Bill 380 deals with the income tax, and it does require, it mandates joint return filing, married filing joint, or married separate or head of household, whichever one applies to a same-sex married couple, the same as it would to apply to, in the past, to other married couples. So those folks are going to need to do a pro forma federal return calculating their married joint income, and that's going to be the basis for their Maryland return. Now, if things change in Washington, if the federal law ever does say same-sex marriage, married couples have the same joint treatment as others, then this provision would disappear and Maryland would simply go back to coupling to federal, having the same federal law. In a couple of other areas for same-sex married couples, Senate Bill 658 dealt with two other aspects. The income tax for a subtraction modification for the federal benefits of health insurance that are paid by one spouse to another. Maryland is now going to allow a subtraction modification for that. And in the estate tax, the bill did establish the estate marital deduction by specifying what the definition of married couple is in Section 7-309. So a lot of folks were looking forward to that clarity and that change in the Maryland law. On to a handful of other things. I've categorized these based on the type of issue that we had. There were a few what I call administrative items. One that might be of interest to a bunch of you has to do with the concept of state tax nexus. House Bill 1513 makes a change for businesses that are in the business of responding to disasters or emergencies like the storm that we are seeing the Oklahoma folks deal with, like the storms that we've had in Maryland that have created a lot of disaster situations, including the loss of electricity. What this bill does is says that in situations where either the governor has declared a state of emergency or the president has declared a federal major disaster area, or there is a widespread utility outage in Maryland, for 10 days before that declaration and for 60 days after the time period of that declaration ends, an out-of-state business who is in the business of sending people and equipment into Maryland to help with those disaster recovery or to help with the power outages does not have nexus, does not have to register or get a license, does not have to file income taxes for the business. Their employees who are traveling into Maryland are deemed not to have non-resident Maryland income. There's no unemployment insurance contribution, no personal property tax, no requirement to charge or pay sales tax on equipment and rentals and things like that. So it's obviously meant to help the disaster recovery. It's going to help those out-of-state businesses. Some of our in-state businesses are concerned about the competition, but some of them are also interested in, okay, it'll be easier for them to get help from their partners outside of the state. Those things were mentioned in the bill, and the legislature saw fit to pass it. So if you have clients who are in that business, take a look at that. In the category of income tax administration, there were a few things that I just wanted to mention. There is, under Senate Bill 1068, now a commission that is going to study the regulation of payroll services. We all read about the AccuPay problems and clients who got messed up with that, and a lot of discussion in the newspapers about lack of regulation of that industry. The legislature is going to study how to implement some kind of regulation. Senate Bill 613 is something new, a new idea. It allows you on your Maryland income tax return to designate your refund to purchase U.S. savings bonds. So that's a new idea that's been implemented. Senate Bill 243 is an administrative item for those folks who do business in Anne Arundel County. The county's right to intercept Maryland tax refunds for any kind of outstanding warrant that is owed has been extended to 2018. And one of the important things about this is Anne Arundel County is feeling success with this provision, and so we are expecting the possibility that other counties are going to want to be doing something similar. On to income tax subtraction modifications. There were a handful of these. I'm going to go through them really quickly. So again, if you have questions, please post it to the listserv. Senate Bill 404 expands Section 10208D. Used to be called the Conservation Tillage Equipment provision. It's now called the Enhanced Agricultural Management Equipment, but there's a subtraction modification for expenditures in that category. Senate Bill 639 provides a subtraction modification for civil rights tax relief. It allows a subtraction for income that somebody earns for non-economic damages in an award over a discrimination finding. Senate Bill 774 modifies the current subtraction modification that applies to volunteer fire and rescue organizations. It now has been expanded to include the Civil Air Patrol. And last but not least, House Bill 706 is a subtraction for reforestation expenses. Just again to show you the breadth of the issues that our Maryland legislature deals with, there was a lot of introduction to that, that the goal is to maintain the health of the state's forest, land, and tree canopy, and so there's a subtraction modification for expenses that are expended in that category. Moving on to income tax credits, there were quite a few discussed and proposed and enacted. Some are changes to old things, some are some new things. A few real quick ones. Senate Bill 124 is the credit for hiring employees with disabilities. That was made permanent. The sunset date was removed, but it also added some provisions for qualified veterans to be included in that provision. Senate Bill 183, the amounts for the film production credit. Some of us have seen the TV and movie cameras downtown. It has become a big business in Maryland. Senate Bill 183 provides that for the year 2014, there are $25 million worth of credits for that industry to be issued, which, by the way, apparently gets snapped up like this. It is very popular, and every dollar of this is spent. And there are studies that show the return that the city and state get on those investments. And then for 2015 and 2016, the amount goes back down to something closer to what we've been familiar with, and that's $7.5 million of total credits per year. Senate Bill 484, for anybody interested in this, there is a new credit for businesses that do oyster shell recycling. House Bill 791 is a credit for electric vehicle charging stations. We are starting to see a few more of those out there. House Bill 1017 provides credits for equipment for wineries and vineyards in Maryland. Senate Bill 41 isn't an outright credit, but it is a task force to study giving a credit or other kind of tax benefit for people who buy emergency preparation equipment. This idea started as a 50% credit for when you buy an electric generator for when your power goes out. That was removed and it was replaced with a task force to study whether they want to do that. Something that more of us do deal with a little bit more, House Bill 386 and Senate Bill 203 made some changes to the research and development credit. Most importantly for those folks who claim the credit, the amount was increased. The amount last year of total credits that the state could grant was $6 million. That has now been increased to $8 million. And also importantly, the new provision makes the R&D credit refundable for a small businesses only, and that is defined as a business that has net book value of assets less than $5 million at the beginning or end of the credit year. So if they otherwise have no income tax liability because of losses or other credits, the R&D credit is refundable now. Senate Bill 779 and House Bill 328 deal with the biotech investment credit. What this provision did to this credit that's been around for a while is to change the definition of qualified investee business. It adds a third item to the description of what kind of business qualifies as one that you can invest in to get this credit. It adds a company that has been in active business no longer than 10 years from the date the company first received a qualified investment under this provision that grants the credit, and that's in addition to the other two qualifications that have not been changed in the statute. Senate Bill 482 deals with the security clearance credit that we were talking about last year. What this does is make an increase to the amounts that you can claim a credit on. It's changed from 50% of up to $200,000 of your administrative costs for securing security clearances for your employees. That $200,000 is an increase from last year's $100,000. And the second part of it is 50% of up to $500,000 of construction and equipment costs for what's called a security information facility. And that $500,000 is an increase from the $250,000 from last year. Now this credit does remain like the R&D credit. They did not change the fact that the $2 million of total credits that the state can grant under the security clearance credit is allocated among all of the people who apply for the credit. So it's a retroactive thing. You apply for it, and then you have to amend your return later after DBED tells you how much of the $2 million you actually get. In that similar category, but a brand new idea, House Bill 803 institutes a new credit for cybersecurity investment incentives. These are for cybersecurity businesses that are looking for investments. The bill adds Tax General Article Section 10733. The credit is 33% of qualified investment amount up to $250,000. It is a refundable credit. You do have to apply to DBED to have them approve that you meet the qualifications. For example, the investor must invest at least $25,000. The qualified Maryland company that you're investing in is qualified if it is headquartered and has its base of operations in Maryland. It's been in business for no longer than 5 years. It's capitalized with at least $100,000, et cetera, et cetera. And different from the other credit, though, this one, the new credit, is a first-come, first-served basis. So it's not the allocation of the total amounts among all applicants. It's if you show up in line and you're one of the first people, it's a first-come, first-served granting of that credit. So that's income tax. Moving on to a few issues that involve various types of sales taxes in Maryland. House Bill 232 was something that actually took a little bit of time in the legislature. It is a new sales tax exemption for parent-teacher associations and other school support organizations. People talked about groups like the Band Boosters, the Sports Boosters Club. So PTAs and those type of school support organizations are now exempt from charging sales tax on their sales for the goal of helping them with fundraising. The Comptroller's Office has been talking a lot about this new provision. They are in the process of writing regulations because there is some clarification that they intend to do in the regulations, so look out for that if you help out PTAs and other school organizations. Senate Bill 631 is a bill that creates an exemption from the hotel rental tax for corporate training centers. There may be only one, but certainly only a few businesses that have corporate training centers that this applies to, but Senate Bill 631 takes care of an exemption for them. Senate Bill 486 applies to motorcycle rentals. If you are a motorcycler and you do a short-term rental, your rental is now subject to the 11.5% short-term rental sales tax. And last but not least, many of us don't deal with this fee per se, but we will be seeing the sales tax return. Senate Bill 745 is adding the result of it is adding a new line to the sales tax returns that we and our clients fill out, because this bill provides that vendors who sell those prepaid phone cards, or what we call the burner phones, the throwaway phones that have the minutes pre-programmed, those cards, those prepaid calling plans now have to have the 911 emergency surcharge fee applied to them. It's not a sales tax, it is a fee that goes to the Public Service Commission, but the way they found to implement this new provision is to have that fee that's collected by the same vendor who charges sales tax reported on their sales tax return, and then the comptroller is going to turn that money over to the Public Service Commission. See, a lot of different topics were covered. Moving on to personal property tax, an interesting bill, Senate Bill 573 deals with the personal property tax rate. Our current statute reads that the personal property tax rate shall be 2.5 times the real property rate in each county. What Senate Bill 573 does is changes it to say no more than 2.5 times the real estate rate. So for those counties who want to reduce their rate, and there were some that talked about wanting to reduce their rate as a business incentive, they can now do that because 2.5 is a max and not a mandate. The recordation and transfer tax area saw some more activity this year, and I know that some of us deal with these taxes in conjunction with our clients' attorneys. Others of us don't see this tax because the attorneys handle it all, but I needed to mention to you a couple of very important things. Senate Bill 202 adds, there's currently an exemption for certain types of transfers between parent company and its wholly owned subsidiary corporations or corporations that are subsidiaries of the common parent. What Senate Bill 202 does is apply that same recordation and transfer tax exemption when you have a limited liability company that is in a structure where you have a parent limited liability company and wholly owned LLC. So the same recordation and transfer tax exemptions will apply in the same circumstances now as they do to corporations. And Senate Bill 436 and House Bill 1209 deal with IDOTs, the indemnity deed of trust, which are financing arrangements that a lot of real estate transaction use. They involve guarantees and the recording of guarantees. These bills made two very important changes to the recordation taxes. One, it changes the amount of a loan, and the IDOT tax provision was put into the law in 2012, and it said that an IDOT of over $1 million is subject to the recordation tax. What this bill does is say that starting this year, an IDOT is not taxable until the transaction reaches $3 million. And the bill also talks about clarity for the IDOT recordation tax applying only on the new money. So again, the lawyers usually handle the filing for the recordation taxes. A lot of us as CPAs do help with the planning for them. So if you are involved in these kinds of transactions, I suggest you take a look at these or send a message and ask some questions, but they are some very important provisions. So those are the tax issues that pass the General Assembly. You see, some of them are things that we will be seeing every day in our lives, and some of our things that I wanted to present to you just to show you some of the things that are out there. There were a handful of things that were proposed in bills that did not pass. Some of those topics were the interest rate on tax deficiencies and refunds. Maryland statute currently has the 13% flat rate. There were bills that proposed changing Maryland's provision to remove that 13% and say that our interest rate would be the IRS rate plus 2%. Those bills did not pass. There were also bills that were proposing to change how Maryland pays interest on refunds. The current bill, current statute says that if the taxpayer was at fault and the result of the refund is something that the taxpayer did wrong, no interest is paid. And in the cases where the state made a mistake and generates a refund for you, they owe you interest starting on the 46th day after you filed your refund claim. What these bills would have done would have equalized that and paid refund interest to you from the 46th day, even if it was a taxpayer error. And there was provision made so that taxpayers couldn't treat the state treasury as a piggy bank. You know, where else can you get IRS rate plus 2%? No bank is paying that these days, so that's why that 46 days was in there. But these bills, that bill didn't pass either. There were several bills proposing to reduce our Maryland corporate income tax rate that was just increased. Those bills did not pass. However, there has been some discussion in Annapolis around the words competitiveness and relativity to other states. So there has been some discussion that perhaps these bills will see some light in future years, but the corporate income tax rate reduction bills did not pass this year. There was a proposal to recouple Maryland to the federal 179 and bonus depreciation provisions that were currently decoupled from. Those did not pass. There was also a proposal to reduce the recently increased personal income tax rate and to reinstate the exemption amounts for individuals. Those did not pass. And there was, yet again, a provision to recouple Maryland's estate tax to the federal via the language of the unified credit, and that bill did not pass. Two other bills that didn't pass, there is a proposal that we've seen a few times that would allow the counties to have different classes of property for their personal property and real property tax, and also have special tax rates where different classes of property would have different tax rates. Those did not pass. And last but not least, combined reporting was proposed again, and it died in the Senate. It did not pass. So that's what's been going on in Annapolis on the legislative front. I promised you also a summary of 2 of the important tax cases. There are a lot of years where we don't have a lot of income tax cases or a lot of tax cases and issues that we CPAs deal with, but there are 2 very important things going on right now. The first one is Gore, and the second one is Win, and I'm going to save the best to last. Gore is of interest to those of us who have clients who either have been or are currently being audited by Maryland for inter-entity transactions. And I'm careful to use the word inter-entity because those of us who've been around for a while understand that this litigation started a bunch of years ago with the old concept of Delaware holding companies and transactions between a parent or sub and a related Delaware holding company that was set up in Delaware to take advantage of Delaware's exemptions. But our experience recently with audits is that the same concept is being applied to all sorts of intercompany transactions, not just Delaware holding companies, and all sorts of entities, not just corporations. So I commend this case to you if any of those issues are of importance to you and your clients. The Gore case does involve Gore, the company that makes Gore-Tex, those raincoats. The Court of Appeals has just granted cert to hear the taxpayer's appeal. The case involves transactions between the parent company and some of its Delaware subsidiaries, and now Gore is a real Delaware company. They grew up, they were started in Delaware, the Gore family lives in Delaware, they have a headquarters and a manufacturing plant in Delaware. They also happen to have operations in a bunch of states. The case involves transactions between the Delaware companies and a subsidiary that Gore has. It has a manufacturing plant in Maryland, involving payments among the companies for royalties on patents that are involved in this business. You can imagine that there are a lot of patents in this technology, as well as interest. The tax court had held for the comptroller. The question is, does the Delaware company have Maryland nexus because the Delaware company is charging these expenses to the company that is operating in Maryland? Or the flip side of that, does the comptroller have the power to disallow those expenses on the part of the company that is doing business in Maryland? Now, the Court of Appeals, the tax court held for the comptroller. The circuit court overturned that and held for the taxpayer and said, no, there is no nexus. These are bona fide business transactions at arm's length and all the rest of that. The Court of Special Appeals heard the case and overturned the circuit court and held for the comptroller, saying, yes, they did have the power to say that the Delaware companies had nexus. The interesting thing to us tax geeks is when you read these opinions, our Maryland courts have, in essence, forged new territory because the decisions are mixing 2 legal principles. They are mixing the principle of unitary, which is a tax concept that applies to the apportionment formula, what can be apportioned to a state, and the concept of nexus, the minimum contacts that you have to have with the state before you can or are required to apportion anything to the state in the first place. So unitary and nexus have been mixed in these cases when you read them. As I mentioned, there are currently many, many other audits that have these issues at bay in the audits. One of the important things to remember is that when the state is pressing that this out-of-state company had nexus and you never filed returns, there is no statute of limitations. So if you have clients that fall into these categories and have not yet been audited, be careful to look at the situation because a nexus holding could make an assessment go back to the beginning of time, and that's one of the reasons that this is so important. And again, not just for corporations and not just for Delaware holding companies, but all sorts of intercompany transactions. So the Court of Appeals is going to hear the case. The taxpayers' briefs are due June 26th, and the comptroller's brief is due July 26th. The court expects to hear oral argument in December in its winter session. So watch your MACPA news for news on that case to see if any of the decision is going to apply to you and your clients. And last but not least, the win case, the win-win, the W-Y-N-N-E-W-I-N for the taxpayer. A lot of us have been following this case for as long as it's been going on. I have been privileged to actually be a part of the case with the taxpayer. Here's what's been happening. Going back to January 28th, when the Maryland Court of Appeals issued its decision in the support of Brian Wynn's position, that he, as a shareholder in an S corporation that does interstate business, is deemed to be doing that interstate business. And Maryland's credit provision that currently allows a Maryland resident a credit for taxes paid to other states on income that's earned in those other states, that credit currently is only allowed to reduce what we call the state portion of Maryland's personal income tax. But the result being that that non-Maryland income ends up staying in your tax return and being taxed times your local county rate. The Court of Appeals held that that is unconstitutional because it's an impermissible burden on interstate commerce. People who are Maryland residents who are involved in interstate commerce will always pay a double tax because they will pay tax properly on that income that's earned and taxable in the other state, and they are also paying the local tax in Maryland. And so the court said things like that is an incentive for a business person to do business only in Maryland so that he doesn't experience that double tax, rather than being able to do multi-state business. And that disincentive to interstate commerce is considered under the Commerce Clause to be unconstitutional. What then happened was the comptroller issued a motion for several things. First, he asked that the Court of Appeals completely reconsider their decision. He wrote a brief saying that the decision was erroneous and that the court should reconsider the whole thing. Secondly, the comptroller asked that if the court wasn't going to change its answer, that they should at least amend the decision to clarify that the results are prospective only for anybody other than Mr. Wynn, meaning nobody else would get refunds, only Mr. Wynn as the litigant would get refunds under prospective only treatment. And thirdly, the comptroller asked that if the court wouldn't change its holding, it should at least stay the decision, meaning delay its effective date, so that the state of Maryland could consider its appeal to the U.S. Supreme Court. They also mentioned consider administrative and legislative fixes. The taxpayer was allowed and did file a reply to the comptroller's motions and, of course, recommended to the court that none of those things happen. So where are we today? Well, if you're a member of the MACPA's Fed Tax or State Tax listservs, you saw my message that on Friday, the Court of Appeals did issue its opinion addressing the comptroller's motions. And first, what they did in their opinion was take the time to write a few paragraphs about a couple of issues that the court found important in the writings that the comptroller had issued in its motions, as well as in the taxpayer's reply. The court first said, and a couple of these things are important to us as CPAs, they first said the original opinion, quote, does not foreclose different treatment in Maryland of income taxes paid in other states that are not based on pass-through personal income. Now, what this means to me, having been involved in this case since the early days of the audit, is that it's a reference to a point that was brought up in the audit that ended up not being involved in the case itself with the constitutional question. But what it means to me is that we all know that there are a lot of states like Maryland that follow the federal treatment of an S corporation being a pass-through entity, and therefore the S corp shareholder is deemed to be conducting all of the activities of the S corporation, and he he or she reports those items on his personal return. But there are some states that still tax an S Corp as though it was a C Corp. There is no flow-through treatment to the individuals, but the S corporation pays C corporate level taxes. This statement to me refers to that provision. And Maryland currently allows a Maryland resident a credit for all states' taxes that an S Corp pays, whether that, or that are imposed on S Corp activity, whether that tax is paid directly by the individual shareholders on a flow-through basis, or whether that tax is paid like a C Corp at the S Corp level. This sentence to me applies to that provision, and so it informs us to be looking out for changes in that Maryland, that current Maryland provision. And then the second thing that the court said was a comment that a state may avoid discrimination under the Constitution, under the Commerce Clause, by either providing a credit, as Maryland does, but under their decision a full credit for the full, up to the full Maryland tax, providing a credit or apportionment. And the court's paragraph said that the comptroller was wrong in interpreting something that the court had said in a footnote in its original decision, interpreting that a credit was the only mechanism that could be used to avoid a discrimination. And of course, the comptroller's position continues to be that that credit can also be eliminated. The state has the right to eliminate that credit. So that's an important sentence for the court to say, that either a credit or apportionment is allowed in order to avoid this double taxation and unconstitutional provision. So then they moved on to the important part. So where are we today? Importantly, the court denied the comptroller's motion for reconsideration. And so the original decision of January stands that Maryland's current credit provision is unconstitutional. Secondly, what they did was to stay the effective date of that decision. So the comptroller now has 90 days from last Friday in order to file its petition for cert to the U.S. Supreme Court. Those are the two things that the court issued in its opinion. You'll notice that I did not say anything about them speaking to the retroactivity prospective only treatment. They didn't. And so that tells me that there's silence in this opinion on the comptroller's motion. It tells me that refunds are due and owing, because the court's decision is that the statute is unconstitutional. It's always been unconstitutional, and therefore the refund claims that have been filed for the open years should be payable. We will see what the state does with that, but my interpretation is that the court's silence on the prospectivity issue means that those refunds are payable. So where we are, bottom line, is we've got until roughly August 15th to see what the state of Maryland does with filing a petition for cert to the U.S. Supreme Court. We all expect that they're going to file. The counties have been very vocal about their displeasure that this means tens of millions of dollars of annual reduction of revenue going forward, as well as cash outlay for those refunds. We do think it's highly unlikely that the Supreme Court would hear this case, would take the petition. Maryland, in our research, is the only state that has this provision. And coupled with the small percentage of tax cases that the Supreme Court takes anyway, we think it highly unlikely that the court will hear the case. And so therefore, what we'll have to do, if we're right that the state does apply for cert, and we're right that the Supreme Court denies cert, then we're left with dealing with what happens with the refund process and any curative legislation to change the current credit provision. So again, watch your MACPA emails for updates. We'll try to keep you informed. So that's what I have for everybody. It's been a pleasure talking with you today. If you have any questions, please post them to the listserv. I'll talk to the camera there. And the MACPA State Tax Committee is going to stay on top of these things. We're out there working for you, so please consider joining us. Thank you for being here, and have a good day.